Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Kriti Gupta. With the cash trade just an hour away, here's what you need to know. Nvidia becomes the world's most valuable company as tech drives a global rally in stocks. Fed officials again urge patience on rate cuts. We will get analysis from Frederique Carrier of RBC and Stephen Auth of Federated Hermes. We'll bring you the latest UK CPI data with the Bank of England's 2% target in sight. Don't miss our interview on the UK with Mel Stride, Secretary of State for Work and Pensions. Plus, France and Italy are among 7 countries to face an EU infringement procedure over their excessive deficits. We will get the latest from Paris.
And just as we're waiting for the UK CPI to cross, a quick check on the markets here. Euro Stoxx 50 futures higher by 0.3%. FTSE 100 futures flat now. That's really a reaction to CPI numbers crossing. We'll break it in a second. Euro dollar 107.36. Cable 127.11. Markets today starts right now.
Welcome to the program, everybody. This is Bloomberg Markets Today, this Wednesday morning. We have lots to discuss. Nvidia, the biggest stock in the world, risk on in various markets, including stocks and oil. Market holidays, at least from a cash perspective in the United States, so lots to talk about. Let's get straight, though, into some breaking news here in Europe, and we go to the UK for that. Basically, as you were in terms of the UK inflation story, everything coming in pretty much as expected, at least for a couple of the lines that I'm looking at here. We've got the core year-on-year CPI number coming in at 3.5%. That's exactly as was surveyed. The year-on-year overall print also coming in as expected. That's at 2%. The month-on-month figure, if you're looking for a little bit of dovishness, the month-on-month figure comes in a little lower than had been anticipated. But interesting to note, and I will go back to what Jemana was saying at the last part of the last hour, actually, around services CPI being sticky, and this was flagged by Bloomberg Economics. That's come in, Kriti, at 5.7%, which is just ahead of the 5.5% expectation. Is down on the previous month, but maybe that's what caused the pound to have a momentary wobble early on a Wednesday morning.
Yeah, and this is in line with some of the, to your point, the expectations on the year-on-year numbers and the month-on-month numbers, but it was also expected that the CPI services would come in a little bit hot because it has been for the last couple of months, to your point about that stickiness. I thought it was interesting, though, that the wobble that you mentioned, it's quite literally the market saying, we're not sure how to interpret this because it's hot on one side, it's disinflationary on the other, to your point. We are seeing cable at 127.17. The knee-jerk reaction was a little bit of strength, but then it's pared back. So
yeah, absolutely. It went up, it dropped, and now it's thinking, perhaps. But we're working our way towards the Bank of England tomorrow. Yeah. No changes expected there. A cut in August is a possibility. Interesting that Bloomberg Economics sees more cuts this year than the market. So the market is pricing in 2 cuts in 2024. Bloomberg Economics says actually there'll be more than that.
Yeah, their argument hinging around the fact that it's going to fall even below 2% in June as well, and actually ultimately get down to about a 2.2% average inflation in the second half of the year. That's relative to the BOE projecting about 2.4%. So again, Bloomberg Economics perhaps a little bit more optimistic than the Bank of England itself, but that's really where they're saying 2 rate cuts expected for the rest of the year, as you point out.
Yeah, and the Bank of England won't want to do too much today that they have to explain to the markets because, of course, they're in this period where they're not really speaking to markets because of the election coming up on the 4th of July. And as we have seen inflation coming down, we've already seen the ruling Conservative Party trying to make political capital out of the success of the Bank of England and perhaps their policies as well. But whatever it has caused it, inflation has been brought back under control and the government trying to draw everybody's attention to that. You do wonder, though, whether this and the uptick perhaps we're seeing in the European growth story might be something that benefits the next government rather than the one that's leaving.
Yeah, and it's interesting in the context of, yes, we said the inflation coming down, but we're still not seeing that real big pickup in wages either. So the affordability question is still one that looms over the electorate as well. And that'll be interesting to see how that all pans out because, of course, to your point about the ruling party, Rishi Sunak has time and time again in many of his speeches said that inflation is a tax. I think is his favorite kind of phrase to say in terms of the campaign. And to be fair, during his time, you look at the data, it has come down, but how much of that is directly related to the fiscal as opposed to the global disinflationary narrative we're seeing?
Yeah, and what monetary policy actors did and, maybe even we can can start talking about it being transitory. It's just transitory over a very long period of time. You know, put parameters around it. Let's talk about the broader market story, shall we, Kriti? Because another record on Wall Street for the broader trading session, and a record for Nvidia, now the most valuable stock in the world. Yeah,
lucky 31, I believe. I think we had the 30th record yesterday, 31 overnight. When it comes to Nvidia becoming the biggest company, this is a momentum story. We've seen this has gone nonstop, and it's been something that's been reflected in the Asian markets, something that's reflected potentially in the European markets. We'll see what the read-through looks like to your heavyweights as well. Was this particularly unexpected?
No,
I don't know.
No, I mean it's the end, not the end. Sorry, but it's the continuation of a trend. The stock's already up 170%. Year to date, more than. So yes, absolutely. Is it just a continuation of what we already knew? I think it's interesting that Microsoft and Apple have been so resilient in the face of the strength of Nvidia, actually. Because, you know, this isn't just a one-stock story. The AI theme does go broader than just Nvidia. Certainly Microsoft making the most of their link-up with OpenAI, and even Apple, which when we saw the immediate announcements about what they were planning on AI, the market seemed to be a little underwhelmed, but given a little bit of time, that seems to have had a positive impact as well.
Well, the relationship, you mentioned the broader market as well. The relationship between Apple and the S&P 500 has been diverging for a couple of months now. To your point on that weakness, a lot of that being the criticism that Apple isn't getting on the AI bandwagon as quickly as some of its other big tech peers. Microsoft, to your point, that 49% stake in OpenAI, very helpful. In terms of a percentage basis, I thought this was interesting. They're just barely edging out Microsoft in terms of a weighting perspective from the S&P 500. 7.27% of Nvidia stock makes up the S&P 500. For Microsoft, it's 7.20. So just barely crossing that finish line. And it begs the question that if you do start to see any sort of cracks in this AI story, a recessionary impulse, et cetera, that pulls back on the AI investment, does Nvidia still hold that crown?
Yeah, so we're battling for $3.5 trillion in terms of market cap. I saw one analyst yesterday talking about the race to $4 trillion. So which will be the first to get there? Or will it be a totally different company? Will it take a little bit of time, and will it be somebody else that we haven't thought of yet? Should we talk about the broader risk-on sentiment in markets? Because yes, we can talk about stocks and where we are on that, and we've done that a little bit. But oil also at a 7-week high, and that seems to be broadly just getting a lift from risk-on sentiment generally.
Yeah, it's interesting because you're seeing risk-on sentiment in the markets, but I would argue if you look at the bond market, it's a little bit different. In just the last 24 hours, when you look at what the Federal Reserve has kind of priced in and the data we got, retail sales came in slightly weaker in the States yesterday to such an extent that it actually created a little bit more pricing around rate cuts. Now, that hasn't shaken up the markets too much. We're still expecting 1 to 2 rate cuts going into the next 12 months when you look at the Fed swaps pricing. But I thought it was interesting. I'm going to nerd out a little bit because we're talking about the stock market. Let's bring the bond market into it. We never pay attention to the 20-year auction. It's just not a maturity that is caught a lot of attention. Insanely strong demand coming into the 20-year. And when you look at analysts kind of a read-through of that, they're saying, well, maybe this came off the retail sales number, that maybe in expectation of a potential rate cut, it created way stronger demand for a maturity that usually doesn't kind of break records.
Yeah, possibly as we're in the middle of the year now, Kriti, aren't we? And a moment to reflect on things that we thought might happen at the beginning of the year that didn't. Rate cuts is one of them, or at least we had much higher expectations around rate cuts. But we also thought that a lot of congestion in bond markets might cause that demand to drop off because there was going to be so much supply. And that hasn't necessarily been the tale of 2024.
Yeah, we keep waiting for these liquidity cracks, right? We keep, we love calling me Kriti the plumber, but this is important.
I'm sure that's Guy.
That is Guy. He's here in spirit, but and we'll be joining the program later this hour. He's still with us. I should mention though, it's interesting because we're talking about liquidity cracks in the bond market, potentially liquidity in the stock market. How much of this momentum story is simply everyone trying to get in on the not just the AI theme, but the fact that tech is a defensive play? That's been a theme that we've heard this year. We've also been talking about it in the private capital markets. We've talked about liquidity in Europe as well. And over again, the narrative is that these fears may emerge, and yet you look at the evidence and it's not there.
Should we talk about something else that has been very topical over recent days and, well, past couple of weeks, and that's the French bond market. But let's turn this into a conversation about deficits. Excess deficit procedures sounds extremely catchy and exciting. But France and Italy and 5 other countries are going to face infringement proceedings from the European Union around the size of their deficits. And what's interesting here is, of course, the numbers and what that does to the, they might be fined, for example. So we'll tune into that. But there's a lot of political signalling goes on here. These rules are set out in the Stability and Growth Pact, which is something that, going back a decade or more has been quite contentious sometimes, and some suggest it puts a straitjacket around countries. And this is coming at a time when France is going to the polls once again, up against an anti-EU, if not Frexit, just broadly anti-EU voice in Marine Le Pen, you wonder how much this kind of movement by Brussels might play into the French election.
Yeah, the magic number is 3%. You want to get that deficit below 3%, or at least that's the mandate. And France famously hasn't. And so that's the reason that the S&P downgraded the country as well, because they said, look, Bruno Le Maire, we don't believe you, that we don't believe you're going to be able to get your deficit.
Any election was
exactly.
Yeah.
And so already the finances were in trouble. It's interesting that France now joins Italy, Poland as well. I love to be our Spanish correspondent. Spain, even though it does have that mass deficit, isn't getting that ire. And I think the expectation is because their finances will get under control and there is a plan out of it. But still 7 countries. And I don't know if Italy and Poland is the right company that France wants to be with in terms of comparing finances.
Right. And what's really interesting here is back in 2011, a lot of the controversy around European finances was around the periphery, and the centre held. And the centre was the one that was really trying to enforce. So that was France and Germany, really trying to enforce these deficit procedures. Now we have a different situation where some of the core is actually telling a weaker story, and some of the periphery, to your point about Spain, is telling a story of strength and resilience. So, so things have changed when it comes to the European political scene.
It has, and it comes also, and again, channeling my inner Guy Johnson, he loves to talk about the fiscal spend in Italy and how much the fiscal story is driving a lot of the outperformance. You see that in Italy, you see that in Spain, in the periphery. You don't necessarily see that in France, Germany, or even here in the UK, even though I think there is that desire on the campaign trail in all of these various countries. The other piece I'll mention is that's all kind of the political story as well. Banks are actually pushing back as well. European banks are pushing back on some of their rules in terms of lending abilities, trading abilities. This follows perhaps the U.S. Also, Jamie Dimon getting that big win, basically saying we don't want to increase our capital reserve requirements because that constrains, to your point, that straitjacket, the lending ability.
And perhaps the European banks then pushing back against what the Americans have.
Exactly. So staying competitive in terms of the sovereign bond market, in terms of the debt story, but also in the corporate bond market as well. So that's going to be something we watch. A couple of other things to put on your radar, though. There's plenty of economic data to keep an eye on. 9:30 a.m. today, you got that UK house price index. We're going to continue to monitor that in the context of the inflationary story. Plus, at 9:30 a.m. at the same time, the ECB's Mario Centeno will be speaking as well. A couple of economic data points in the U.S. Not that much that is really tradable. Those mortgage applications. It will be coming out about 10 a.m. But you also have the German economy minister Habeck beginning a trip to South Korea and China. This coming amid a lot of the back and forth that we're hearing between the EU and China in terms of trade policy, et cetera. And of course, we should mention that the U.S. markets are closed, the cash markets and the cash and the treasury markets as well in the States.
Yeah, absolutely. On your point about the German economy minister taking a trip to China, yes, it's notable that Germany was one of the countries that was not happy, really, with European policy around Chinese EVs. They fear retaliation. We've seen some of that retaliation from China in the pork markets, though, not in the car industry. So we'll see where that one plays out. Yes, you're right to point out that we do have some market closures in the United States. It is Juneteenth. So as you say, no cash treasuries, no cash equities. Those futures will be open in terms of stocks, treasuries, oil and metals. So as we watch oil at 85.33, so back above $85 on Brent. We will have an early close on Brent, but we do at least have some trading in the meantime.
We will. And that, I think today that just leaves a little bit more room for Europe and arguably for Asia as well to have a little bit of a catch-up trade and then see what unfolds in tomorrow's session when the U.S. is back open.
OK, just to let you know what's coming up on the programme then, over 60% of businesses say they lack the confidence to integrate AI and green technologies due to the UK's skills shortage. So this is UK businesses. We will get the details from a report from the British Chambers of Commerce. Plus, we'll speak to the CEO of Bosch ahead of the company's 2024 Tech Day. We'll talk about EV sales. We'll talk about the auto sector. That's at 8:15 a.m. London time. Don't miss our interview on the UK with Mel Stride, UK Secretary of State for Work and Pensions. We'll talk about the latest polling on the Conservative Party. We'll talk about what they're trying to do to turn that around. If you have any questions for our guests, please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Welcome back to Markets Today. We're about 43 minutes we'll call from the cash equities open. You want to see futures pair a little bit of their earlier gains here. Euro Stoxx 50 futures higher by, we'll call it 0.1%. FTSE 100 futures flat, and a lot of that coming right off of that CPI data, which I think we should go straight into. Coming bang in line expectations at 2%, which both Bloomberg Economics and the consensus expected. The cable doing a little bit of a wobble, as Anna would call it. But let's dig into the data a little bit, because services came in hot, whereas the overall number came in bang on target. Hetal Mehta, head of economic research at St. James Place, joins us this morning to help us digest it. Hetal, pleasure to have you on the program. Good morning. Walk us through your take on this data. Is this kind of a all clear ahead signal?
I think this is one of those data points which keeps everyone happy. You've got core inflation falling, but it's not fallen quite as much as people were expecting. So I think that it will keep some of the hawks still in play, keeping them very cautious around signalling any kind of premature loosening of policy. And obviously we've got to remember for the Bank of England, tomorrow's meeting is one where there's very little communication. They don't want to rock the boat or make any moves that require a lot of explanation, given we're in the election period. But I think the overall numbers are good, but maybe not good enough to signal a big change yet.
But then on the other hand, the services number still came in hot. And to be fair, it's been hot for a little bit now. What do you make of that? Is that cause for concern?
That has been, and it's been a story for several months now, that the services numbers are just super sticky. And we know services and wages are very, very intrinsically linked. And we had the wage numbers last week, which were a bit hot as well. So I'm not surprised by that. And that's going to be the key thing for the Bank of England. That needs to start giving way before they can really signal a willingness to cut.
Hetal, what do you think has brought inflation down? Because we'll quickly get plunged into a lot of political voices having their say on what's driven this. We've got monetary policy at play. We have got fiscal policy at play, of course. We've got global influences. What do you think? What's the analysis as to what's been effective?
So, to a large extent, it's been base effects. So us economists like to talk about them all the time, but it is a low-hanging fruit that just because prices didn't go up as aggressively in the last few months as they did a year ago, that's allowed inflation to carry on drifting lower. But that's the easy bit. The hard work is still there. And I think we do need rates to stay higher for a prolonged period to just keep that pressure on. Even though we've had a very minor recession in the UK, that's not been enough to squeeze out the services and wage inflation that's needed.
Yeah, and what's the trajectory then for wages and for inflation from here?
So we're starting to see a few cracks in the labour market. I mean, the employment picture is not quite as rosy as it was a few months back. So that should start moderating wage demands. It's just letting that kind of the second round effects kick in, but in reverse. So where you have a little bit more uncertainty around unemployment and you start seeing less pressure on wage demands. Also, we know wage demands are a bit backward looking, linked to what inflation has been. As that starts to moderate, you get that virtuous cycle, but it just takes quite a long time going down versus going up.
How much attention should the BOE be paying to fiscal policy in terms of post-election, where the spending priorities are, if there is even any room to make that maneuver? What does the BOE make of that?
So the Bank of England will, I think, take a very cautious approach. Of course, I'm sure they'll be reading the manifestos like the rest of us. But until there is a budget or a spending review, I don't think there's a huge amount that the Bank of England can say or do. They have to work with the current policy as it's laid out. In all reality, the next government will face a lot of spending constraints at least. They won't be able to do a huge amount unless they are willing to put up taxes to fund that. We've had our own experience with, bond market hissy fits. So I think the new government will be cautious around that. And so for the Bank of England, fiscal policy is not going to be a big support to the economy. And if it looks like growth is slowing further and needs support, then it's likely to be monetary policy that comes to the rescue.
I love that you called it a bond market hissy fit. We're seeing plenty of that on the other side of the English Channel. France has a very similar issue in terms of debt, has a very similar issue in terms of politics as well. To what extent are we in for a hissy fit 2.0?
Well, we saw the reaction in French bond yields to obviously the announcement of the election and what the prospects of a party which is talking a lot about significant fiscal loosening does. I think it's going to be moderated a bit in the sense that talk is talk, and actually the reality of government for any party can be very different. And plus, it's unlikely that we're going to have a strong French government that will be able to follow through with anything like that sort of fiscal easing that's been discussed.
Isn't it interesting the way that markets respond to strong majorities and strong mandates? Because sometimes the market sees that as a negative, other times a positive. I suppose it comes fundamentally down to the, what do you have a strong mandate to do? And in the French case, it will very much depend on the makeup of the parliament and who has the levers of power there.
Yeah, that's right. And we saw very different reactions, say, to the Mexico election result versus the India election result. And I think a lot of it is about what the opinion polls are telling us and how surprised we are. But some of it's also about whether we have a government that needs to be reined in a little bit and not put forward some of their more radical policies. And that is actually probably what the market mechanism is, to just try and keep that discipline.
Do we care about liquidity at all in these markets? And I know you of course, are focusing on the economic read-through, but there really is one, especially when it comes to the BOE and arguably the ECB as well, that has perhaps, I want to say, had a little bit more of a hawkish and dovish tilt, relatively speaking. Are you paying attention to any sort of liquidity cracks when it comes to spending ability, when it comes to the bond markets? How do you view it?
So one thing that's been surprising, despite a lot of political noise, is just how well-behaved markets have been in general. But when you look at the VIX, very, very low by historical standards.
Yeah. And
I also look at the European Central Bank's composite systemic risk indicator. That is super low, surprisingly, despite everything that's going on. We've just recently seen the European component of that pick up. But actually, it's been very well behaved. So the systemic stress is not there. It does seem like there's still enough liquidity in the market to kind of bear the brunt of some of the political noise for now. But it's a piece of elastic. At some point, it will give if it's pulled too hard.
What's the red flag there? What prompts that?
I think if we have a really big announcement on fiscal easing anywhere that is unfunded, and we're not seeing the discipline that needs to kick in for the medium term. If that's not there, I think the market will actually start getting quite worried.
As we look towards the second half of the year, we're not quite in it, are we, Hessel, but looking towards the second half of the year, Kriti and I were talking at the top of the programme about the things that markets got wrong in their assumptions. One of them was about the number of rate cuts we'd get from the United States, and that hasn't happened, but stocks have carried on regardless and been really resilient in the face of that. What are your priorities? What are you thinking about for the second half of the year? Second
half of the year, it's still election fever. We've got the US election in November, so until then it just doesn't really get quiet. I think we will get to a point once we get eventually closer to the Fed cutting, the Bank of England cutting, where the focus does become even more towards the fiscal. So it has been very much about monetary policy, will they, won't they, on central bank cuts. But I think fiscal policy can be very meaningful, in fact, more meaningful and quicker.
Well, we've seen in the US, they've benefited from that fiscal policy around the Inflation Reduction Act and other policies. Does that mean then, if it's all about the fiscal, does that mean the currency of last resort and the US exceptionalism means the US wins, if this is some kind of battle? Does that mean, the US wins versus others because they can do more fiscally?
Yes, they can, and they have done so far. Again, I think we're getting to a point where we're testing limits. We're getting into uncharted territory. It's clearly one of the big risks, and the spillovers to Europe are also very important, I think. The US does have that enormous privilege. It will probably continue to use that. But I think the spillovers to the rest of the world could be meaningful. And fiscal policy loosening in the US should be seen as a global boost stimulus-wise. Monetary policy, you can cut it both ways because one person's loosening is another person's tightening through a currency channel. On fiscal policy, fiscal stimulus in the US should be seen as growth positive.
All right, Hessel Meza, Head of Economic Research over at St. James Place. We thank you so much for breaking that down. Coming up on the program, UK businesses say they are struggling to integrate AI and green tech due to a skill shortage. We discuss that with Martha Lane Fox, President of the British Chambers of Commerce, next. Stick with us. This is Bloomberg.
Welcome back to Markets Today. 30 minutes from the start of the cash equities trading session. This is what the picture looks like in terms of the markets right now. The futures picture for Europe is entirely flat. We're not necessarily going to get too much of a clue from the United States later. We have no cash trading in the US. It is Juneteenth, so that applies to equities. It also applies to bond markets. For what it's worth, and US futures, equity futures are open. They look pretty mixed as well. So we don't have a great deal of direction. We're coming off a new record, though, for stocks, and that's the overarching picture with Nvidia now the biggest stock in the world, having taken over from Microsoft. Over in the United States, the biggest stock over in the United States. Let us get into a conversation now about what's going on in the UK. And the UK inflation picture has been brought down. It's fallen to the Bank of England's target for the first time in almost 3 years, supporting the case for interest rate cuts later this year. CPI rose 2% from a year ago in May, down from 2.3% the month before. Joining us now is Anna Andrade from Bloomberg Economics. Anna, take us through your key takeaways from the data. We haven't made enough of the fact that this is back down to target, which is exciting for everybody who gets excited about those kinds of things. But I suppose sticky services inflation will still give some pause for thought.
Yeah, hi, good morning. So you're exactly right. This was a bit of an awkward print because we had headline inflation coming in at 2%. It was sort of in line with our forecast. It's a little bit above what the BOE had forecasted because for this month it was looking at 1.9%, but that's all manageable. The worst part is the services, and services came in at 5.7. And so that's above the 5.3 that the BOE was forecasting. It was also a surprise for us. And we know that the Bank of England has been sort of, tolerant to data surprises, but 0.4 percentage points on services inflation, which is the component that it's looking at to sort of assess the persistence of domestic pressure, it's not great news. And it's also like, the BOE could overlook it if it had only been driven by sort of volatile components like airfares and accommodation. But when you look at the details, it's stickiness across the board. So overall, it's progress, but, for the Bank of England, it will definitely give it pause for thought.
What is the configuration to rethink that strategy, Anna, in your view? And this, of course, comes as we're seeing some of the pricing change. Well, traders now paring back their rate cut bets, pricing in about 39 basis points in 2024. Walk us through, then, what the red flags may be post-election.
Yeah, I mean, I think overall the print, and not only this print, it's important to flag that it's this print and the prior print where we saw a big, that's where sort of the big surprise to services came. And April was an important month because it's a month where a lot of prices get updated, and we had the increase in the national minimum wage. And what the data is sort of telling us is that we're still in an environment where firms are comfortable passing along the higher costs. And that's not really what the Bank of England wants to see. So for us, these two data prints together sort of made us reassess a bit the policy outlook. I mean, we still think that a summer rate cut is on the table. I mean, that won't come in June because, as you said, we have the election and it will be seen as sort of the Bank of England meddling and interfering with the election campaign. But we still think that an August rate cut is on the table because we've seen a lot of progress. Headline inflation is at 2%. Now, because of the stickiness in services, we actually think that the Bank of England might not cut as much as it wanted to. It had signals in May that 75 basis points worth of easing was what it was considering. We now think it's probably more likely that it will cut by 50 basis points only. So at the quarterly pace, that means a cut in August and a cut in November.
Anna, thank you very much. Anna Andrade from Bloomberg Economics with us to talk about the UK macroeconomic backdrop. Let's talk about some other policy areas in the UK. According to a new survey, more than 3 in 5 businesses say they've been impacted by the country's skills shortage, and it's hurting their ability to integrate AI and green technology, crucial to economic growth. Joining us now, Martha Lane-Fox, President of the British Chambers of Commerce and Chancellor of the Open University. And this report, Martha, good morning to you, is a product of a joint effort between the two, between the BCC, I think, and the Open University. So thank you very much for joining us on this. What kind of impact is this skills shortage in the UK having on UK productivity, would you say?
Very important impact, just about growth. We're not going to be able to make our businesses more competitive globally, but also just grow the economy, as every single politician has said ad nauseum in the last few weeks, if we don't make sure we've got the right talent to do it. It's so fundamental, and it's depressing that 62%, nearly 3/4 of our businesses are feeling anxious about skills in their business. And crucially, in my opinion, feeling anxious about two enormously important areas of skills development over the next decade: AI, digitization, and the green economy, where we're going to need people if we're going to build a modern, robust economy for 2030, 2040.
And no doubt, yes, you with the BCC and the Open University, and obviously the latter is a skills provider, and so you're probably providing a lot of skills in that front, and therefore have a lot to say on the subject. What is the message to the next government then, in terms of laying the groundwork for skills from here?
Well, I think the first thing is to really recognise the issue, and perhaps naively, I maybe shouldn't admit this on TV, but when I first became president of the BCC 18 months ago, I come from the technology sector predominantly. I'm used to never having enough skills because you're always inventing stuff, you don't really have the right people. But I was so shocked by the skills issues across every sector, every bit of the country that I went to, whether it was hospitality, whether it was social care, whether it was advanced manufacturing, defence, whatever the area I was lucky enough to be understanding. So I think there are some things that are working. And one of the things that we run at the British Chambers are the local skills improvement plans. We run them on behalf of the government. They're great. They are a framework for businesses to sit down with a local set of both skills providers, universities, schools, other people that can help solve the issue, to map out what the local businesses need and what the local area can try and build capacity. And so there are things that work, and we really hope that any future government pays attention to that. We did a report called The Future of the Economy, and we looked particularly at people at work. There are loads and loads of policy ideas in there. So there's no shortage of ideas, but it's also about businesses themselves. Having faced such tough economic headwinds in the last few years, whether it's been supply chain issues, whether it's been complexity through Brexit, whether it's been rampant inflation, all of those things, unfortunately, skills training budgets do get put down the list and deprioritized. And so we know that there's just been far less investment, and it's very important for the future of any business that you keep investing in your people. So we'd also encourage the right framing and the right issues to be put at the top of the investment list for our businesses, because otherwise it's going to be much harder to make sure we're not in a much worse state by 2040.
So no shortage of work, but plenty of a shortage of labor. To your point, Martha, migration has been a big feature of this election, and we appreciate the cat making an appearance as well.
Yes,
hello to the cat.
About the subject.
I fully understand. Pets are always quite vocal. Talk to us about what that clampdown on migration in particular means for the skills shortage. Are there certain sectors that are more vulnerable than others?
Yeah, absolutely. I mean, you guys know this, you report on it frequently, but one of the things the BCC was campaigning for a year or two ago is an extension to those short-term visa lists that the government had set up as a result of Brexit, skills that we definitely need in the economy. And we always welcome any policy shift that keeps Britain an open global market, because that's what we are and what we should be. We need talent from all over the world to build capacity in our businesses and in our future industries. So it's really important we don't shrink. But it's also important that we train local workforces and make sure our own people have got the skills that they need. And that's why I'm such a proud Chancellor of the OU that does such an amazing job in helping people upskill or retrain or get into work. And so it's both parts, but they're both equally important.
Where does apprenticeships play a role? Rishi Sunak has been emphasizing that's the way forward, promising to scrap rip-off degrees. Where do you stand on that? Mm-hmm. Is that the right approach?
Well, I think it's a really interesting debate, isn't it? And I think one of the things that the OU has shown me, 63% of our learners are in work. And so there are such valuable resources like the OU that can make sure that you really have those skills you need for the next decade in your work. And so, of course, we have to think really carefully about whether, when people are paying money for a degree that's going to lead to something that's helpful in their life beyond the social aspect or just learning and curiosity. I feel that there's room for everything. Of course, we want to make sure that the higher education sector is giving value back to people. We can point to incredible examples of how that works with the OU and others. But I also think we must be really careful not to denigrate higher education and its importance in the UK. We've got unbelievable universities, some of the best universities in the world, constantly top ranking. Hello, would you like to go to one? And so we must protect them, because they are global assets, and we mustn't do anything to make sure that they're undermined.
And Martha, just before we let you go, and if the cat will tolerate one more question, we've had some tech businesses in the UK, startups in the UK, saying, Zilch just this morning saying they might go somewhere else in terms of a tech listing if there's no improvement to the UK IPO scene. You once listed a business back in the 90s, early noughties in the UK in the tech space. What thoughts do you have as we head into perhaps another political era in the UK about how we make the UK more attractive for listings?
Well, I'm super happy that both Rachel, Johnny Reynolds, Kirsten, they've all been talking about how vital it is to make sure that the UK is a place to grow a business, that wealth creators are welcome, that entrepreneurship is valued. And I think that those are all the right signals, but we need to keep that pressure up. Just this week, numbers came out to show that London has gone back to its dominant position as a listing hub across Europe, which is fantastic. But that doesn't just happen. It happens through work and intent. We need to keep that focus up. And part, for me, of that is just marketing and politicians realizing it's incredibly important that they have that role to be global ambassadors for the exciting opportunities that we have in this country. So I welcome what any future government is saying about this stuff, and we just must make sure that it's always top of the agenda.
All right, Martha Lane Fox, president of the British Chambers of Commerce. We thank you and your cat so much for joining Bloomberg Television. We really appreciate the time from you both. Coming up on the program, we are going to walk through your stocks to watch, including Vodafone, the UK-based carrier selling its $1.8 billion stake in India's Indus Towers. More on that next. This is Bloomberg.
France came into this episode with a weak positioning towards its deficit. It's the second largest deficit in the Eurozone, only second of Slovakia. It's one of the highest ratio debt over GDP at 110%. Remember that 2 weeks ago, S&P downgraded its rating. So the narrative was pretty harsh on France before the election, and it's getting even worse.
Raphael Touan, head of capital market strategies at TKO Capital, speaking to us yesterday about France's deficit and the issues leading up to, of course, the current electoral volatility that we are seeing. In the meantime, Bloomberg has learned that France and Italy will be among 7 countries facing an EU infringement procedure for their excessive deficits last year. The indebtedness could limit the next French government's ability to implement its plans. Let's get a little bit more on this. Eleonora Mavaridi from Bloomberg Economics in Paris joins us this morning. Eleonora, as Raphael Touan over at TKO was pointing out, this has been something that's been in the works for a while. The French government has been borrowing way faster than some of its European peers post-GFC. What are the consequences now, at least imposed from the EU?
Well, clearly it's not surprised that France is also included in the excessive deficit procedure. Debt has been increasing, deficit widened since last year, interest payments are increasing. The current government was willing to, or showing willingness to put finances in order and comply with the EU rules, with their stability program, very ambitious stability program. But now the elections put severe risks to this outlook. Whoever wins is likely that it will lead to fiscal slippage. And that's why markets are worried. And the question is, by how much? So to answer this question, we look at the programs of the main opposition.
Yes, Eleonora, I was going to ask you about that. I was going to ask you a bit more about that. And is the concern does the concern centre around the National Rally and also around the far left? How much has your analysis revealed about the extent to which markets should be concerned?
Well, there are reasons for the market to be concerned. Because we see whoever wins is most likely mean that France will not meet the EU fiscal rules and will ask risks to the debt sustainability. So what we should focus on is the National Rally and the left-wing coalition. We try to put some numbers, preliminary numbers, to their programs, and we find that they can range quite widely. So in the case of the National Rally, the program could add as little as 8 billion to the deficit if they stick to the explicitly stated policies, but there is high uncertainty over that. So in the case that they include more costly policies, such as the reversal of the pension reform, then the impacts would be much higher. In the case of the left-wing coalition, our preliminary estimates suggest that they would add 60 billion to the deficit. In that case, the impact on debt and deficit will be much larger. Debt could increase to 121% by 2027 compared to 113% in our baseline, and deficit could widen by more than 6% by 2027. So in both cases, we see that there will be a breach to the EU rules, and that makes markets worry. And also, even if Macron manages to stay in power, then his ambition will be reduced, as his government is probably going to be weakened.
Eleonora, thank you very much. Thanks for bringing us the analysis. Eleonora Mavridi from Bloomberg Economics. Joining us now, Ven Ram from our Markets Live team to talk about the markets in 2 minutes. Ven, without the United States in any meaningful sense, yes, futures are open, but elsewhere, no cash trading later on. So we could see lower volumes. We're coming off new highs, though, for US equity markets, and a new #1 in terms of the largest stock in the world being Nvidia. Where do stocks go from here, do you think?
I think stocks will be bid no matter what, because that's the paradigm we've been handed of late. If you look at NASDAQ index, I mean, from the lows of 2022, just 2 years ago, we have seen stock prices nearly double. Now, which business is going to grow at a 50% compounded rate annually? There is virtually no business that grows at that rate. And it is a dictum of the markets that markets can't forever outpace the growth in their underlying businesses. Benjamin Graham said, investment is most intelligent when it is most business-like, and investors seem to have forgotten that dictum. The longer they forget, the worse the outcome is going to be. It's hard to say when the shoe will drop, but when it drops, it's going to drop hard. Now, what it means for the Fed is rather important here, because the Fed looks at a trifecta of conditions. Look at the economy. The economy is growing above trend this year, 2.1%, well above trend growth. The Fed will take that. If you look at inflation, we still got a 3% handle. That's not good for the Fed. It's not in the postcode where they want it to be. If you look at financial conditions, the third of the trifecta, I mean, financial conditions are the loosest now that they've been in more than 3 years. So if you add all that together, what you get is that the Fed is going to stay higher for longer, regardless of what stocks do.
Ven, just briefly, we've been thrown by French politics recently. Do you see any buying opportunities?
Well, I think that, French securities have been sold a lot, but if they sell off another 10, 15 basis points, I think they would be in bargain territory. Why do I say that? Because if you look at the French sovereign rating, it's a AA handle at the moment. The worst that could happen to them is drop to a single A handle, which would put it in terms of pari passu with Spain. And Spanish bond yields are trading at 87 basis points over Germany. And that is where the bargain territory begins.
Ven, thank you so much. Ven Ram from our Markets Live team. You can get further thoughts, expanded thoughts from Ven Ram and the team. He's been writing about gilts as well this morning. MLIV Go is the function to use on the Bloomberg terminal. Let's get a check on markets and the stocks that could be on the move. Joe Easton has a briefing from our equities team. Joe.
Morning, Alice. We're starting in the UK home builder space because we've got a pretty positive update out of Berkeley Group, one of the UK's largest builders this morning. Now, they are upping their pre-tax profit guidance, saying they expect it to hit around £525 million for the year, above analyst expectations, and also point to the benefit of the interest rates potentially coming down later this year and the election as well. They say the next government is set to prioritise housing, and they think that will be a benefit for demand. Now, the interesting thing for me is this stock has already recovered the 3-year decline that we've seen in the sector since interest rates rose, and that's due to the fact that their order book has remained steadier than a lot of their rivals. We can see pretty deep losses in the likes of Pearson and also Barratt, a loss in Taylor Wimpey as well. But Berkeley, over 3 years, up 10%, so potentially this could feed back into the positivity for this one this morning. Of course, the key thing ahead is the Bank of England rate. We had that inflation data earlier. Potentially tomorrow is going to be too soon for a cut, but when that rate that we've got on the screen starts to come down, that will give a broader boost. But for now, Berkeley looking pretty positive on those numbers. Then we're also looking at Vodafone here in the UK, offloading a big stake of an Indian tower infrastructure group called Indus. They're selling around $1.8 billion worth of the stock today, and that did spur a bit of a sell-off in that company's share price over in India overnight. It's an 18% stake of Indus Towers, and it's part of the new CEO, Margarita Della Valle's performance in terms of selling off some of the assets that aren't doing well. She's looking to sell off some underperforming assets, and that is part of that. Vodafone has been a big decliner over the past 5 years or so. There's a lot of competition in the key markets like the UK and Spain and Germany as well. So selling these underperforming assets is part of that turnaround program. As I say, there we see on the screen, down 45% almost over 5 years. Then we've got a pretty shocking warning out of SMA Solar. Now, this is a small solar company over in Germany in terms of market cap, but it is actually the largest in terms of output in the country, cutting their guidance today, warning of deteriorating demand across their businesses. Analysts over at Jefferies saying they're surprised by the cut. Here's what the CEO said on the screen. The reason for cutting the guidance: persistently volatile markets in solar, weighing on their orders, seeing some very sharp losses on the Tradegate exchange, and keep an eye on some peers like Acciona, ERG, even Ørsted Renewables in focus today.
All right, Joe Easton, our equities reporter, bringing us some of those stocks to watch. He, of course, will be back with the open after the open with the ones that are actually moving. We thank you so much. And like I said, we're about 5 minutes or so to the European market open. You're seeing futures fairly flat when it comes to Eurostock 50. Some underperformance in the FTSE 100, perhaps coming off of the CPI number. We're going to dive into the details. Plenty of deal flow to talk about, or lack thereof, in the IPO market. Plenty to digest ahead. Of course, we're going to bring it to you, plus the full fallout of what's going on in France across these markets and the read-through from Nvidia. Stick with us. This is Bloomberg. We're just a few minutes away to the European market open. Welcome back to Markets Today. There's a lot to digest here. Remember, Nvidia hit a real record in the U.S. trading session yesterday, hitting not only a record high, but also becoming the most valuable company in the entire world, overpassing Microsoft, Apple, and even Saudi Aramco in terms of valuation. So that's going to be something to watch. What is the read-through, however, into the European session? Remember, the U.S. markets are closed today, both in the Treasury market and the equity market. So we're going to see if that big cap tech read-through, Anna, shows up in some of the big tech names here.
Yeah, it's an awkward read across, isn't it, into Europe? We've seen it in Asia. We've seen it pushing some of the chip companies higher, and we've also seen it pushing Apple suppliers higher. We have a bit of that theme here in Europe, but not quite so aggressively. And we saw some of this yesterday, of course. But when we look at the sectors that actually were on the move yesterday in Europe, it doesn't tell the same story around optimism for tech and risk on. Utilities was the best performing sector in Europe yesterday, up by 1.5%, followed by some more cyclical ones like construction and materials. But, you know, that's not the same vibe as Nvidia to the moon, is it?
No, it's not quite the same vibe. And I think we're also going to be monitoring, of course, what the read-through and continued read-through of the political fallout in France is as well, as we see that political uncertainty, what kind of buyback or even appetite for buying back some of the French stocks actually looks like. In that same vein, we've seen luxury stocks take a pretty big hit from the China risk as well that feeds through. And I should just quickly mention, as we haven't already, the Golden Goose IPO is shelved due to the political uncertainty and due to the drop in luxury valuation. So we'll see what the appetite looks like following that.
That is interesting. It's having an impact then. And we are seeing that some of those luxury names were moving actually in quite opposite directions yesterday. So the likes of LVMH moving lower, Kering was moving higher. So it's a sort of a mixed picture, which is something in itself. So just seconds away then from the start of the European equity trading session. And the futures picture was really quite inconclusive. The US futures picture also looks inconclusive. We will, of course, be without the United States. It's Juneteenth, that public holiday in the US. So as a result, we have no cash equities or cash treasuries trading today. But we do have futures open stateside. They're pretty muted. A little bit of upside on the NASDAQ futures, but not very much. In terms of where we've opened up in Europe, then, we're flat on the Stock 600. The FTSE 100 also pretty flat, waiting for the CAC 40 over in Paris to open. The DAX is a touch firmer this morning, Kriti.
Yeah, we're still waiting for the opening prices on ASML as well, because traditionally when we do see that big cap or a big tech read-through in the States, ASML is going to be one of the big ones. SAP is another that we keep our eye on. We're still waiting for the opening prices on that for some of the market to shake out. But it looks like right off the bat, SAP now starting to see a little bit of weakness. It is pulling down on the stock 600, even though overall the sentiment is a little bit higher. We'll see what ASML does as well. In terms of those French stocks, BNP is one of your biggest index contributors to the upside. So I think that's interesting when we're talking about the appetite for buyout, but kind of broad strength that we're seeing, but again, not by a major margin.
Yeah, interesting. The basic resources is the best performing sector. Oil prices are a little bit weaker, and I was just looking at the GMM screen to remind me of any outsized moves in other commodities. I see iron ore is up by 0.9%, so that can be something that moves some of the London-listed iron ore businesses. But London is not outperforming, so even though basic resources is the best sector, London is down by 0.2% today, as the overall market is pretty flat. So London underperforms is certainly one of the dynamics that we're dealing with, even with that strength in mining names.
Yeah, and we should mention then as well, we are seeing the French index also underperform as well, even more so than the FTSE slightly. And some of those, even from the stock 600, the read-throughs going into Total, for example, that's one we're keeping an eye on. Airbus starting to pair. I mean, look, it's only been literally 2 minutes since the opening, but you are seeing some volatility in Airbus as well. And I'll just bring to everyone's attention as well that Airbus and Maersk are both dealing with some reported deal flow stories. Airbus potentially, at least reports around it, suggesting that Poland may be considering some sort of stake. So that's going to be something to keep an eye on. But again, early reports, no actual commentary from Airbus either. Maersk as well, some rumors, at least in the markets, that they may be reconsidering their Schenker sell-off as well. So that's going to be something we watch. But net, what you need to know, I think, is that it's a little bit of a low volatility story. That's a conversation we had earlier this morning with Hetal Mehta of St. James Place, who's basically saying, look, these markets may be a little well-behaved. Take a listen to what she had to say.
When you look at the VIX, very, very low by historical standards.
Yeah.
And I also look at the European Central Bank's composite systemic risk indicator. That is super low, surprisingly, despite everything that's going on. We've just recently seen the European component of that pick up. But actually, it's been very well behaved. So the systemic stress is not there. It does seem like there's still enough liquidity in the market.
Frederique Carrier, Head of Investment Strategy at RBC Wealth Management, joins us now as well. Frederique, good morning. Pleasure to have you on the program. Do you agree with that take, that systemic stress isn't necessarily there in a market that maybe momentarily freaking out but are well-behaved?
I think that's right. Last week, there was a bit of a shock in the market about the elections being called unexpectedly by President Macron. And since then, people have started to reason a little bit that maybe the situation is not as bad as expected, that even if the far-right party gains a lot in many seats in the National Assembly, the Senate is still powered by a different party, which would not leave full freedom to this far-right party. So there are still some steps in place, some institutions in place, so that it's unlikely that they would have unbridled power.
So at the core of the story, though, is spending ability or lack thereof from the French government. It's easy to see how that translates into the bond market. How does that translate into the stock market?
So we saw stocks such as utilities, infrastructure, defense, and banks in particular. Banks were hit very strongly. It might be one of the reasons why utilities are bouncing back today. But for banks, for instance, higher cost of capital, windfall taxes on banks, these are all very strong worries. Banks are always very sensitive to changes in government, and usually this uncertainty lasts until the second round. Infrastructure, people are worried about the loss of concessions or perhaps the government forcing lower prices. But in the contracts of these concessions, there is a clause for compensation, so things are not as bad as one can imagine. And finally, for defense, of course, the far-right party would focus more on national defense as opposed to foreign engagement. So these defense stocks, which in Europe have done very, very well, have been very, very expensive, retreated on the back of that.
Frederique, can I talk about the US as well? Because we've seen yet another record on US equity markets. We've got many tens of records so far for US stock markets, and Nvidia now the biggest stock in the United States and the biggest stock globally. I saw that Howard Marks over at Oaktree Capital was saying AI stocks, in his view, are not in a bubble. What is your thinking? What shapes your thinking on whether these AI stocks are in a bubble?
So we don't think they are. We still think that particularly for the enablers, there's still some opportunities. Semiconductors, the whole semiconductor value chain, but also the infrastructure, so cloud computing, for instance, as well as data centers and all their ecosystems. So the industrial companies which give cooling systems or power management, we think that there's more to go there. Interesting that this rally is not only Nvidia, but also other companies, broader rally. So we think that there's still upside potential, certainly for that theme,
yes.
And also for the US market. Now, we recognize that 23 times earnings is quite elevated, but valuations can go even higher. So we look out for market breadth, if there's any deterioration, or for extreme investor sentiment for a very long time. Sentiment at the moment is elevated, but we don't see it as being really extreme.
And what do wealth management clients have to say about diversification right now? Because that might be a mantra for many, but at a time when you see AI stocks doing so well, maybe it's tempting not to diversify.
It is tempting indeed. So this is a conversation we have to have with our clients, that markets are strong, but it's important to prepare perhaps for a rainy day coming on later, because we forget, but the risk of recession is still reasonably elevated at about 30% probability, and we see some lead indicators starting to turn. So we need to keep an eye. We really need to be watchful.
So in that context of that conversation, the optimism around AI, the optimism around the resilience in the States, what do you do with Europe?
With Europe, we have a market weight, and we look very much at opportunities in companies which can really benefit from secular growth. And when there is an upset in markets, as we've seen last week, for us, it's an opportunity perhaps to add to positions if this move gets overdone, because there's a small probability of things going really wrong, and the market has always a lot of difficulty to price that in. So we find some opportunities. There are some very good global players in Europe, strong secular growth players, and we would want to take advantage of that. And if, of course, the move gets overdone, if investors get too worried, we would look to add to positions to these companies in the sectors I've mentioned, which have been hit.
Yes, remind us again then. Do you see secular growth opportunities then in the French things that have been sold off? So, for example, French banks or French luxury?
So French luxury would be something to keep an eye on, definitely. It seems to have been in the crosshairs. It's a sector which is well held, and when you want to sell your European holdings because all of a sudden you're frightened of what might happen politically, then it's one of the stocks that you sell. But some of the corrections are overdone in our view.
Frederique, thank you so much. Thanks for joining us. Frederique Carrier, Head of Investment Strategy at RBC Wealth Management. Let's get a check on the markets then, how they're trading this Wednesday morning. Let's get back to Joe Easton.
So we've got SMA Solar absolutely hammered in Germany today, down 27%. It's the worst decline in 12 years for this company. Now, bear in mind, this firm had a market cap of around $4 billion just a year ago. It's now worth only around $1 billion. So really getting hit hard on worries about demand in the statement today. Jefferies, as I said earlier, saying that this equates to a 60% downgrade to EBITDA forecast, and the outlook is deteriorating for that solar company. They're Germany's biggest in terms of their output. Not seeing a huge read across, a little bit in Acciona Energia and ERG, Ørsted holding steady. Potentially this is more a single stock story, but the biggest decliner we've got by some way this morning. Then in terms of your UK home builders, and also going to check in on the banks as well, we had the Barclays Group earnings. That actually looked reasonably strong, but the valuation on Barclays, as we were saying earlier, is actually the highest among some of those peers. So that stock actually coming down today. Taylor Wimpey unchanged at the moment. The banks also in focus. A little bit of movement in Lloyds. We had that inflation number, the services part of that was potentially higher than expected. The Bank of England in focus tomorrow. We'll wait to see what effect that has on that one. Then in terms of chips, you were talking about Nvidia a lot on the show, powering higher to become the US's largest company. So we're checking in on the European chip makers today. Pretty steady. Nvidia kind of stands alone. Infineon in Germany actually ticking lower at the moment. Not a huge Nvidia effect this morning, but that is now the biggest company in the world. No trading in the US today, of course. In terms of the deals, now we've got two in the tower space. This is not intentional. We just coincidentally have two tower deals going on today. Vodafone offloading $1.8 billion worth of that Indian company Indus. That's a big sell for them, and they're getting a bit of a gain, 0.7%. And Helios Towers, this company is an Africa-focused tower infrastructure company. An investor dumping a load of stock today. They think it's overvalued, and they're selling that one down, and it's dropping 7% in the London market today. Two morning calls to bring you really interesting one. Firstly, in France, because there's a rating change on Accor. Now, this is the owner of Ibis Hotels and a lot of other hotel chains like Novotel. Barclays has a note saying that the sell-off in a lot of the French stocks, like Accor, is actually overdone because most of the exposure is internationally. They don't have a huge French exposure. It's an international company. They reckon this is an opportunity to buy that firm, and it's gaining 2.3% today. Finally, the best performer in Europe today, Umicore. Massive profit warning from the chemicals company just last week related to EVs, but JP Morgan reckons the sell-off in that one is also overdone, and it's gaining almost 6% today. As I say, the best performer on the Stock 600, Umicore, over in Belgium this morning.
All right, Joe Easton from our equities team, we thank you so much for bringing us those stocks that are on the move. Coming up on the program, the CEO of Bosch joins us to talk about the company's plans to boost its software offerings and the path ahead for one of Europe's largest private companies. We're going to dive into that next with that interview. Stick with us. This is Bloomberg.
Welcome back to the programme. 8:15 here in London, 9:15 over in Germany, where we head next. This is the picture for European stocks. A little lacklustre this morning, but overall flat. The Stock 600 pretty flat. Now, the German electronic and technology giant Bosch is aiming to significantly boost software sales as it hosts its annual Technology Day. The head of the company, which is not publicly listed, but he has recently stated he is open to listing parts of the business. Let's talk about the business as a whole. Stefan Hartung joins us, the Bosch CEO. Stefan, very nice to have you with us. So you're hosting your Technology Day. Clearly you're focused on software and what AI can deliver. Is this an area where you want to make acquisitions, Stefan? Are you looking to expand in this space?
Well, we are expanding in this space because software and AI is obviously the key ingredients for modern product. And that is unlimitless, probably where you can apply it. And in our product space, which we deal with, which is a lot of automotive, there is a new opportunity now coming up because vehicles will be controlled much more by wire. So most of the physical connection in the vehicle will go away. And that means many problems which have to be solved in a vehicle can now be software or AI problems.
OK, and thinking about, so you are expanding in that space. I don't know if that's an area you want to do M&A, but you have signalled that you're interested in doing deals, in hinting at bigger deals, possibly focusing in the US. Can you tell us anything about your priorities for where you might want to grow the business through M&A?
Well, definitely in software, it's more about partnerships because that makes a lot of sense. There's also M&A happening, but it's more with smaller companies because they bring technology to us. But definitely in the software space and the AI space, you have to partner. And we have done that, and we are doing this with large players and smaller players. And that's very important because in the end, Bosch brings this technology into product, so into application, which is physical. And that's our role. So you will see us bringing this into cars, into ovens, into kitchen appliances and others. And that's mostly done by partnerships.
Stephen, it's Kriti in London. Pleasure to have you on the program. Building on that theme, how can you reassure your investors, your creditors, that you may not be overpaying for any sort of partnerships or acquisitions when it comes to the AI space, given how high the valuations have been driven up?
Well, the key is actually that AI in the end needs to find its way to the consumer. And obviously, you can do that direct with building platforms which are like generative AI platforms directly to communication with consumers. And what we are doing is mostly that we bring it into physical products to enhance product functionality. For example, in these wire-controlled vehicles, we can bring software packages which are vehicle motion control packages. So these are controlling the vehicle, how it rides, and you can freely program and parameterize the vehicle, how it steers, rides, brakes, and accelerates. That's a complete new way of integrated control of the vehicle, and that's a big surplus for safety, but also for comfort. And you can do something which is obviously very important. You can adapt it to consumers. And that's a lot of value, which obviously people are interested to bring it into, definitely also people who do AI and software and which have high valuations. So better to partner with those people. That makes lots of sense, and partner into bringing this to consumers.
But that, again, feels a lot like an American-driven story, excuse the pun. Stephen, to what extent are you looking at opportunities locally, not just in Europe, but in Germany as well? Or is that a weak spot, do you think?
Well, the Europeans also have good startups dealing with AI models and bringing AI to specific applications. So we also have partnerships here. And our activity is mainly focusing on bringing things together with our customers. So you will see this not only in the automotive space, but also in the home appliance, because also in the home appliance, it looks like a technology which you know since decades. But still, there's a lot of application where we all want to have more comfort and more easiness, especially when we are cooking, especially when we do complex recipes, especially when we use appliances which have more complex capabilities. And this would be the future, that the appliance helps you doing a better cook and the car helps you being a better driver. And this is why we do these partnerships. Yes, you're right. Many of the partnerships in AI will be with US partners, but there's also European partners. So it's a global thing which goes on.
Stefan, I don't drive much, but I do cook a lot. So now you're speaking my language. But going back to the auto sector, I want to ask you what you're seeing there, because that is such a big part of your business. And clearly, this is a sector that's been struggling with a lot of volatility in demand around EVs. What do you make of the sector's prospects at this point? How is that feeding through into your business?
Well, that's actually a good message in general, because the consumer decides freely what he wants to buy, right? That's a thing which we also have to learn always. And in the automotive sector, obviously, now it's not a linear progress towards the electromobility, but it will continue. There is a dip now which we have to go through, yes. And also you see that after the catch-up which we had last year, the growth in the automotive sector is much slower this year, definitely. But the technology is progressing. New vehicles are in the making all the time. So the industry is kicking, and you also see an interesting competition which is now rising with technology in China and also in the US and Europe. So while we see on the same time that electromobility may be a bit slower this year, which is the case, and which has an impact also on us, we are also seeing that the car industry in total is progressing, and it will go to more electromobility, more automation, and more interesting cars in the next decades, as it always has done.
You mentioned that competition statement from around the world. Are you readjusting your strategy, given that protectionism is also on the rise, specifically when it comes to the recent developments from Europe towards China? How does that affect your plans?
Well, we are a global player, so we want to actually work on all areas on the world, and we work with partners in all areas on the world. So for us, protectionism always is not a good thing, which we want to see. On the other hand, it's clear that it is happening, and therefore we need to be strong in all areas in itself. So we have a strong footprint in China. We are increasing our footprint in the US. We have a strong footprint in Europe. And therefore, we have to be capable in all areas also to deal with circumstances which are not favorable, for example, with higher tariffs. That's something we have to deal with. But in the end, that doesn't change our strategy, which has always been local for local.
All right, Bosch CEO Stefan Hartung, we thank you so much for bringing us this interview. We appreciate your time. I want to stick with the world of transportation and go from Bosch to Boeing. The plane maker CEO Dave Calhoun has faced searing criticism in a U.S. Senate hearing that zeroed in on the company's manufacturing shortcomings and accused the company of putting profit ahead of safety.
You and your board of directors have a duty to your shareholders, but they will be deeply ill-served if you fail to correct course to confront the root cause of this broken safety culture.
Let's bring in Bloomberg's Benedict Campbell, who leads our global aviation coverage out of Berlin. Benny, any new revelations, anything we learned from this hearing?
The short answer is probably no. And it wasn't really the kind of forum where you would learn new things. It was more of a, should we say, lecture. So Calhoun sat there. He was contrite. He was humble. He was almost nervous, you know, somewhat fidgety. But that's not necessarily a bad look. You don't want to show up at these events with swagger and being glib. So he sort of struck the right tone. There was a moment early on, and I think we're seeing it in the clip here now, where he stood up and faced the audience, and many people in the audience were family members of victims of those two Boeing crashes. So that was a bit of a moment for Calhoun that sort of tried to set the tone. Other than that, it was a lot of, as I said, lecturing from the podium. The senators were sort of going quite hard at him, faulting him for the culture that he'd failed to turn around, putting profitability over really the products. So that was really sort of where most of this conversation went. Some of it was a little bit meandering, sort of how we got here, what went wrong. Some of it was a little weedy. It was almost 2 hours long. In the end, you know, an uncomfortable session for Calhoun, but he sort of got through it okay.
Okay, yeah, and you're right. We did see those pictures of him turning to face those who were assembled. How did he do in terms of dealing with any attempted knockout blows from senators? I mean, from the senators' perspective, it must be a slightly difficult line to walk, because you want to, in front of the families of victims, you want to obviously take this very seriously, but you'll be sort of geopolitically aware, geoeconomically aware that any knock to Boeing is somebody else's advantage.
Yeah, you're absolutely right, and that is a fine line they need to walk. And Senator Blumenthal from Connecticut, who chaired the meeting, made that very point. He said, we want Boeing to succeed. Nobody wants to see this company go under. This is an important company. It's an icon of U.S. manufacturing. It's an important player in the military, so we want this company to turn around. At the same time, they want to sort of lay bare the issues that Boeing faces and that they have faced over time. Issues included, the pay that Calhoun made. That was one particularly contentious moment where one senator sort of laid into him for the $33 million that he'd made last year, asking him, what do you make your money for? This seems like a ridiculously high amount of money. And can you justify that in face of what's been going on at the company and what the humble worker makes? So that was a bit of a moment, but it was also, a little bit of sort of, should we say, outrage, fabricated outrage, and that's part of this game. It's part of sort of the back and forth between these two sides. Senator Blumenthal accused him of delivering gobbledygook documents, and that was almost comical, that part, because Calhoun had to then admit, yes, that is in fact what we have done, and he vowed to do better going forward.
All right, Bloomberg's Benny Camel walking us through the developments of Dave Calhoun's testimony in the U.S. Senate. We thank you so much for bringing us that analysis. And it's something, Anna, that we talk a lot about with Guy, where he basically says that, look, this is a company that really only has one major competitor around the world. It's Airbus, of course. There's already a change-up at the top as well. Is this just simply too big to fail? Even though we're watching Dave Calhoun's testimony kind of bit by bit, how much does this change? Yes, and Benny is setting out very nicely there how they do have to walk that fine line. They really need to take the safety record seriously. They really need to point out the safety concerns, but at the same time, they'll be very mindful of the competitive environment between Boeing and Airbus. Yeah, I mean, look, the safety is, of course, going to be on top of everyone's mind. But for me, Boeing is a big Dow component. It's a big S&P 500 component, and it's still, even though it has this big hit, hasn't necessarily taken an even bigger hit that you may see or may have expected. And I think that's a big part of the conversation, just in fact of the market. How do these heavyweights factor in? Which brings us to what we're going to cover after the commercial break. Nvidia, of course, becoming the world's largest company. This is Bloomberg.
We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at one or two rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both.
I will need to observe a period of favorable inflation, moderating demand, and expanding supply before becoming confident that a reduction in the target range for the federal funds rate is appropriate. These conditions could take months and more likely quarters to play out.
I believe economic conditions are indeed moving in the right direction. If the economy evolves as I expect, it would become appropriate to begin easing policy sometime later this year.
Fed officials speaking about the rate path ahead. Kriti, interesting there we heard one of the voices talking about the period of favourable inflation that he needs to see before policy can be adjusted. Those conditions might take months, could even take quarters to achieve. And this goes back to, we've been hearing this message for a little while. Certainly earlier on this week, we were hearing messages that suggested some Fed officials still want to see more evidence of that disinflation story coming through in those inflation prints.
Yeah, it's a fascinating one because everyone's so convinced that we're on the right path, even if that path is maybe slowing down just a little bit. And you can see that in the market pricing with these cuts getting pushed further and further out. I think what's interesting, though, is kind of their long-term commitment still to that 2% target, because on the corporate side of things, specifically in the tech space, we were talking about Nvidia quite aggressively all morning long, you're starting to see price increases, right? You're seeing that there is still this massive investment in AI. You have companies in the States, like, I'm going to nerd out for a second, Broadcom and Qualcomm, that are seeing price increases, talking about as much as 25 or 30% for their root product. And I'm having a little bit of 2021 deja vu, where so many companies are actually hiking up their prices.
Yeah.
You compare the tech story to something you're seeing in the retail story, for example, your Walmarts in the States, for example, that are cutting down on prices to adjust that disinflationary trend.
And so we'll watch where that pricing power story goes, in particular for tech, and how that feeds into the inflation story. I think the global context is really interesting as well. Just this morning, we've been talking about the UK getting inflation down to target, basically, even though there's still stickiness around the services side. And earlier on this week, we were talking about the RBA in the other direction. They're not thinking about cutting rates at all. They're thinking about, they held this week, but they're thinking about whether they need to hike rates. And so just another illustration of the sort of divergent policy that we're seeing around central banks.
Yeah, we'll add another one in there. Tomorrow we've got the S&B as well coming in at, I believe, 8:30 a.m. Tomorrow, London time, I want to say. And already they front-run the ECB, and that was already one that was unexpected. And already even the fact that you have a fairly dovish ECB, you were still having a Swiss bank that gets even more dovish.
Yeah, absolutely. So the Swiss and the Swedish and the ECB now cutting, the Bank of Canada as well, but not everybody on the same page then. Let's talk about where we are on the equities story. Stephen Auth joins us, CIO for equities at Federated Hermes, on set with us this morning here in London. Stephen, nice to have you, as always, on set. Let's start with Nvidia, the Nvidia effect. AI and data centers has really paid off for this business. What concerns do you have now about valuations, or are you not concerned about valuations around that sector?
I'm not concerned about valuations in the U.S. market broadly. We're certainly getting, Nvidia at 40 times next year, $3 trillion. Its market cap is roughly 10% of the U.S. GDP. It's a terrific company. It has reinvented the wheel. It's almost going to drive the next leg of this bull market. So I'm an Nvidia fan, but the market's going to have to start broadening out. It already has started into sort of Nvidia-like related plays in HVAC, utilities, TSMC out in Taiwan. You're seeing a broadening out there. And we think probably the back half of the year is going to be a continuing of that broadening out theme.
Okay.
At least that's what I hope.
Yeah.
If Nvidia goes up another 100%, which it very well could because it's becoming a momentum trade, the long-term valuation of Nvidia is probably about where it should be. If I had to predict where it would be in 2 years, I'd guess it might be around this level.
Okay.
I'd rather it just chop its way.
Yes, the stock's already up more than 170% year to date, isn't it? So it has a habit of
So we're not
doubling.
in a bubble yet, is what I'm saying, but another real big move up. And then, those are dangerous because then the move down is painful and...
Yeah. The size of the U.S. tech sector, clearly, if you're exposed to that, you've benefited on the upside, and you maybe want to think about downside protection. What kind of do we have to think about systemic risk when we see so much concentration of the market within tech, or is that to overplay the wider effects that this sector can have?
I don't think systemic risk. You're usually talking about the financial system and its ability to infect the rest of the system. These companies have pristine balance sheets. They have no debt. They're massive cash flow generators. These are not even the internet companies of the 90s where there was no cash.
But I suppose I'm thinking more about the wealth effect that's created by all of these stocks going so much higher. And if that were to reverse very quickly, that could have a macro effect, maybe not systemic then.
Yeah. But with the strong cash flows that they have, it's hard to envision a crash in those stocks from here. From much higher levels perhaps, but... and the U.S. household sector has also made off well, which in the U.K. is not as appreciated because the housing market here is different, the way people finance mortgages. But U.S. households have financed themselves sub 3%, 30-year fixed. So as the Fed has raised rates, a lot of households have actually benefited from higher rates on the asset side of their balance sheet. And that's what's kind of causing the Fed conniptions, because as they raise rates, they're almost helping at least the higher end of the consumer sector.
You mentioned the piles of cash that these big tech companies are sitting on. You could argue that about a lot of the S&P 500. It's still kind of this leftover post-COVID era. How much of this is a liquidity story? I ask every guest this question simply because my favorite Nvidia fun fact is, one, that it's a momentum trade, to your point, and two, that 45% of their data revenue comes from the 4 richest companies, not only in the States, but in the world. How much of this is just a cash transfer?
Yeah, well, there's been good liquidity in the U.S. market for sure, and I think that's a fair comment, but it's not a liquidity-driven market per se. There's been sufficient liquidity, and it's still pretty high because the household sector is, as I said earlier, is pouring, pulling cash is pouring in every day. So,
yeah.
Where does that liquidity tighten up? We're gradually seeing it. The Fed is hanging in there. The Fed's not going to cut until things calm down. And, we've been thinking one cut in December. But one of the things that we're kind of excited about for the back half of the year is the market will stop talking about how many cuts this year. I mean, who cares when you're down to 6 months? They'll start talking about how many cuts this cycle. And with, the Fed funds rate is at 5.5%. The inflation rate, by the way, you mentioned the 2% target. I think the Fed's kind of informal target is something a little under 3.
Yeah.
They'll be happy enough. And, they're running about there now. The labor market's still kind of tight. They want to see that soften up. It's been softening up. By the back half of the year, it probably does. They bring rates down. And I think people start talking about the long-term direction here. If you've got inflation running at 3 or 2.5, the Fed funds rate only really needs to be 3.5.
Yeah.
That's 200 basis points away. And once they make the first cut, the conversation will be more about the future cuts. And that's partly why we think the broadening out of the market, which has been long awaited, will start to happen in the second half, because those stocks need lower rates.
How does that show up globally, though? And one of the big narratives, one of the big bull cases for the European market is that so much of it is exposed to that U.S. consumer resilience story. We've had CEO after CEO come here and say, our Asia market is weak, but our American market is making up the gap. Is that a reason, in the face of the threat of higher valuations in the States, to buy Europe?
I think as rates come down, Europe is unfortunately or fortunately part of this broadening out idea. It doesn't have much tech stocks, as you guys keep pointing out. It's got SAP, it's got ASML, but it doesn't have that big tech sector. It's more of a value index. It's got the banks, it's got the industrials, it's got the commodities companies, and it's those stocks that need lower rates. So they're kind of part of the broadening out story. You got to get through all these elections in Europe this summer and the fallout from them. That's causing a lot of uncertainty right now. But, our view on that is the market finds a way to discipline these governments. When you have debt to GDP of 30% or something, you do what you want. When it's 100%, the market tells you what you're going to do. That's what Liz Truss demonstrated. So we're not so worried about what the French do. Their degrees of freedom around how aggressive they can get on fiscal policy are just very limited.
So you think that the global view would be that markets will keep Le Pen and the left in check?
Absolutely. Absolutely, they will. And the market will start to scent that out, same way with the U.S. election. And I think you get through that, and it's another reason for the broadening out that has not happened yet to start to come through.
You seem very optimistic on Europe, despite the election risk in the UK and France and in the States. How do you price it in? What's the trade?
Yeah, I can't help myself but be optimistic, because against all that, you got a valuation 10 points below the S&P, in a way. So, I have to be optimistic. And, I would say the banks here look interesting to us. A lot of the commodities-type companies I mentioned earlier. And there's some great little growth stocks in Europe, too. So.
And when we're done with European politics, we'll move on in short order to US politics and all of the uncertainty that could be generated there. You have some interesting thoughts about the types of businesses that will benefit under a Biden 2.0 or a Trump 2.0.
Right. Well, we seem to be heading towards a Trump 2.0 unless something dramatic changes. His gap in the swing states is widening, not shortening. So the market, I think, started taking that into account, but it's still too early to call. So in a Trump 2.0, it certainly favors this broadening out idea, because as an example, he's going to be more aggressive about keeping the tax cuts on small businesses, which comes out as high net worth individuals, but most of them he's going to be more aggressive about trying to preserve those. That helps the small business sector, which has been the one that's been hurt most and is underperforming right now in the U.S. market.
But it also, to your point, as juicy as that might be for the small businesses, and even for the markets, arguably, that does also put the U.S. deficit in a lot of peril. Isn't that a reason to sell the states?
Yeah. That's what people said during the Trump tax cuts the first time around. And if you look at the CBOE projections of where we would be today in terms of the federal deficit based on the tax cuts and where we are, they're off by, hundreds of billions of dollars. So the Republican argument is if you cut taxes, it raises growth and raises revenue. And that has more or less happened. You could give credit to the tax cuts for that, other things. But at the end of the day, the tax cuts have not proven, the end of the world for the U.S. market. It's actually improved growth probably.
Well, they haven't in previous iterations of this policy, right? It also comes with a campaign platform that comes with tariffs, which is inflationary, and economics have proven that. It comes with geopolitical risk. We've got 2 wars in this region alone, not to mention the issues going on in the South China Sea. Do those not cancel each other out?
Yeah, the tariffs are the thing that has the market most worried. But here's how I would, I know you think I'm Pollyanna.
No, hit me. Come on,
All
Stephen.
Right, here's the thing. We've been through this before.
Yeah.
And a lot of the market sees Trump as negotiating with tariffs. And, people even said that Xi would rather have to deal with Trump than Biden because he feels like he can do a deal with him and get it beyond him as opposed to sort of an ideological confrontation that's going to last the next generation. So we'll see. But I think a lot of the market for now is willing to accept the negativity around the tariffs on the idea that there's some sort of negotiation in play here. That's certainly the evidence of Trump's first term. But we'll see. I mean, the pessimists would say, we're going to create a trade war and the world's going to end. I don't know.
Stephen, you said that in Europe, the markets will keep deficits in check. They'll keep governments in check, as we saw with Liz Truss.
Yeah.
The US operates in a different rarefied air. What will the role of the markets be? You're talking about tax cuts there. I mean, they might or might not be funded in some sense. So what will the market's role be under Trump 2.0 if that's where we end up?
Yeah, I think the bond market does, and it does kind of matter a little bit in the U.S. It's more this cycle than ever because the size of the U.S. deficit and the fact that, U.S. consumers funded themselves long at low rates. The U.S. government didn't. So as these treasuries get refunded, the government needs lower rates, and the bond market has more control than it used to have over U.S. spending as a result of that. So, I don't think it kind of creates a Liz Truss kind of crisis per se, but bond yields are partly up here because of the size of the deficit, and there's only so much they can do before it becomes a self-fulfilling vicious cycle. So, my guess is that'll keep things somewhat in line.
What's not priced into this market, Stephen? If you're feeling like the markets have a little bit of faith in the tariff negotiations, the deficit stuff is going to get on both sides of the Atlantic is going to get sorted. What keeps you up at night? What's the market missing?
Well, I've been doing this for 40 years, so not a lot keeps me up at night.
You've learned.
That's good to hear. Yeah.
Yeah, otherwise I wouldn't be still doing it. I don't know. I think, you could have something out of the blue that happens. That's usually... Everyone's been worried about the recession. And the economists last year kept moving it forward to 10:30 on October 2nd. Then it got moved to December. And, okay, so maybe. But that doesn't seem likely given the strength of the consumer sector, which has got plentiful jobs and high wages.
Yeah.
And the banking system is solid.
Yeah.
It's already withstood a couple little hits here last year. So I guess it'd have to be something geopolitical that is really... you know, you can't completely predict what some of the folks running places like China and Russia will do next. And
all right.
maybe that's a thing to worry about.
I think the message here is that 40 years in the business, and you're hardened perhaps by the market. Stephen Auth, we have to leave it there. CIO for equities over at Federated Hermes. We thank you so much for joining the program. Coming up, a new poll showing that the UK Conservatives are on course to lose more than 2 in 3 of their seats in next month's election. We're going to speak to Work and Pension Secretary Mel Stride next. This is Bloomberg.
The Conservatives now have had, you know, they've had a fairly long stint, and they've put forward a whole series of prime ministers that haven't been terribly successful. Everybody in the UK now, you can see that the mood in the UK, everybody's ready for a change. They've had enough.
Jim Ratcliffe, the INEOS chairman and founder, on the state of UK politics ahead of July's general election. Let's stay with the UK. Inflation has fallen back to the Bank of England's 2% target for the first time in almost 3 years. It's a milestone that will be welcome news to Rishi Sunak and the Conservative Party, which remains, though, 20 points behind in the polls. Let's get into a conversation here. Joining us now, Mel Stride, UK Secretary of State for Work and Pensions. Secretary of State, very good to have you with us. Thanks for joining us. So some success on the inflation front in that we're back down to target, but the real stickiness in the services side of the economy. Are you at all concerned that inflation once again rears its head?
Well, look, I think we've always got to be vigilant, but I think we mustn't resolve from the very significant achievement that this marks. I mean, inflation in the UK was up at 11.1% back in the autumn. It was the prime objective of our Prime Minister to get that down. And that is now, as you say, down this morning at 2%, which is exactly the Bank of England's target. So we're in a very good place. And that's about the lowest level in 3 years. And of course, it's going to be good for taking some of that pressure off the cost of living pressures that people have faced here with higher inflation, and also good for business going forward. And also part of that journey, hopefully, with the Bank of England through time beginning to lower interest rates.
Mel, some of the wealthy business leaders, though, that we've been hearing from over the past 24 hours have not been so positive about the Conservative Party's record. Billionaire John Caldwell telling other media that he previously gave money to the Conservatives. Now he's going to vote Labour, he says. We played some sound there from Jim Ratcliffe of INEOS, the UK's second richest person, pretty critical of the Tories' record on a number of fronts. What does it say about the party that these individuals are no longer excited about what you have to offer?
Well, they are, as you say, individuals. There are a lot of business people out there, many of whom are very supportive of the Conservative Party. And in fact, back at the time of the autumn statement, when we'd introduced something called full expensing that really drives investment in businesses, about 200 businesses wrote a public letter at that time saying how important and transformative making that particular set of tax breaks permanent was. And so I think, it is a mixed picture, but there are many businesses that are very positive about what this government's doing, particularly on getting taxes down. And that's the key dividing line between ourselves and the Labour Party, is we are absolutely determined and have a clear, bold plan for getting taxes down. Under Labour, those taxes are going to be rising very significantly and quite conceivably on businesses, amongst others.
Well, some businesses are also looking for a party that might be worming a little bit more towards Europe. Lib Dems, for example, being very vocal about this. What do you say to those business leaders that are looking for that thawing?
So, look, it's a very important market, clearly, the EU, and that's why we have our free trade agreement with the EU, the biggest, the most ambitious that the EU has ever entered into. But we also recognise that outside of the EU, the economy is growing faster across the world than it is within the European Union. So there are very important growing markets right across the world, and that's why we've struck now many trade deals with other countries around the world to capitalise on that. So, of course, the EU, very important, and we're always working with our European partners to squeeze out friction within our trading arrangements. But we have left the European Union, and one of the positives of that is that we are now at liberty to go and strike those deals with other countries and other trading blocs across the globe.
We've seen a number of MRP polls, these deep dive polls that go sort of seat by seat and work out what, or give us predictions about what might happen. What do you make of the polls that give you as few as 72, 73 seats, Mel? Do you believe what we're being told by the MRP polls?
Well, it's certainly the case that for some time now we have been substantially behind in polls generally. But of course, the only poll that really matters is going to occur in a couple of weeks' time, and that will be the general election on the 4th of July itself. What we've got to do during that time is just draw out properly and transparently what Labour's plans are on tax. They have a £38.5 billion black hole in their unfunded spending commitments. They haven't said how they are going to fill that black hole. They've categorically ruled out some taxes, but when you ask them about others, they can't be categorical about ruling those out. And that tells you that there are areas where there's a tax tornado coming our way if we have a Labour government.
OK, I mean, the Labour Party has pushed back on some of the Tory suggestions about higher tax, but I accept that they haven't ruled out every single tax that is possible to rule out.
Tax,
perhaps.
Inheritance tax, capital gains tax.
Yes. Yeah. The IFS has been critical of both parties, both of these major parties. But that takes me to another question, actually. How convinced are you that you will be, if you don't win, how convinced are you that you will even be the official opposition? This is an idea being floated by other wannabe oppositions, of course.
Well, I don't want to speculate on exactly where the election will end up. I don't think that would be right for me to do. But let me make a general point that I do think is important and relates to your question. And that is that if it is to be the Labour Party with a massive landslide, 450, 460 seats in our Parliament out of 650 in total, then what is going to matter is having an effective opposition. So I think part of my message to the UK electorate today is to really think about what kind of parliament you want. If you're sitting there thinking we're definitely going to have a Labour government, and many people are, then think about having Conservatives in there, think about having a strong opposition, because otherwise I think we're going to be tantamount to having a one-party socialist state here with the kind of majorities, which would be, if the polls are correct, would be the highest majority probably in the history of our country. And I think that is something that would be less than satisfactory.
Mel, thank you very much. Thanks for your time. Mel Stride, UK Secretary of State for Work and Pensions. Kriti, that just about brings the show to a close. It can be a quieter market day because of the absence of the US later. European equity market's pretty flat. Actually, the FTSE 100 down about 0.2%, so not Paris underperforming today, although they're all a little weaker.
They are, and I think the currency market's interesting as well. Euro dollar 107.36. I'm seeing some strength, however, in cable when you look at sterling against the dollar. 127.29 there. Again, coming off of that CPI report, so ultimately ending up in strength. That things are, at the end of the day, all on track. That does it for markets today. The Pulse is up next. Stick with us. This is Bloomberg.